Hello, hello. Welcome, everyone. Showing live on Instagram. Or maybe not. Maybe not Instagram today. Because I don't know how to do that. Cool. We will get everybody started. If you're joining us early, can you, in the comments, put where you're from, just the location of where you're from? The town you're from would be great. City, state, be cool. Put that in the comments so I get an idea and a feel from where y'all are attending from. Double check, make sure that everything's working. Okay, cool. I think we're good. I think it should be streaming on all platforms. Let me know if that's not the case. If you're on Facebook, Instagram, YouTube, all platforms there. So just a quick little introduction. Bill's not here today. For those who follow Bill, Bill's traveling for work. So you guys just got me and only me today. If you are part of the inner circle that Bill and I'm a coach in the inner circle now, it's a great community to be in. And I think if you're a real estate investor, if you're somebody looking to scale your portfolio and learn the proper way to invest, Bill's a great person to be around. And it's more about finding that community, like finding the tribe of your type of people that invest in the same areas that you do, share the same sort of problems that you do, and all that good stuff. So get plugged into a community. You know, if it's not Bill's, if it's not somebody else, just get plugged into a community. If you're a real estate investor, I know that was a big help for scaling my portfolio. Just to give you guys a little intro. So my name's Ryan. I currently am a real estate CPA and an investor, just like you. I bought my first house with actually only $2,500 out of my own pocket. So I used an FHA house hack. So I lived in one side, rented out the other. And that first property that I bought, I think I ended up paying something like $400 a month to live, because the tenant on the top of my duplex was paying a pretty king's ransom for rent at the time, is what it seemed like. But with my low mortgage and what they were paying for rent, I only had to pay $400 out of my own pocket. And that's when I was kind of connected to Bigger Pockets, and I was going through the forums on Bigger Pockets in the community. And then I stumbled across this thing called short-term rentals, and I saw people posting about short-term rentals and how they just cash flow a lot more than long-term rentals. And it seemed to be a way quicker way to build wealth, other than Bigger Pockets, Brandon Turner sort of style, where you're going to cash flow $200 a door, and then hopefully 20 years later you'll have enough of those things in order to retire. That to me wasn't fast enough to me. I am about building wealth slow and the right way, but that to me, it wasn't definitely wasn't quick enough, right? So when I bought my first short-term rental, what was so crazy is oh, here we go. Now we're live on Instagram. That's how we do that thing. Okay. Cool. That is live there. And then I think I have to go live somewhere else. So I was saying, when I bought the first short-term rental, instead of doing $1,200 a month gross is what I would think I was getting for my long-term rental, my first short-term rental in the first month that I rented it out did a little over $3,000. And so it did three times the amount that a long-term rental would, right? And so it was just a way quicker way to build wealth. And then since then, I've bought more short-term rentals. I've gotten into glamping, RV parks. I've done a little bit of everything, multifamily. And then, last but not least, I've built up my CPA firm too, because I became so passionate about helping real estate investors just like you uh, learn how they can use the tax code to build wealth, because the tax code is just going to allow you to get to your destination a lot quicker, a lot quicker. If you're able to not only put a 10%, 15% down on a property that's going to cash flow, but then also bankroll in those tax benefits that's going to allow you to buy more property because you're saving more money in taxes. It's kind of like this revolving sort of hamster wheel. And so, at least up until this point, I've made it my life's mission to help real estate investors utilize the tax code to their advantage and to be proactive and not reactive. A lot of times, this is part of the segment I wanted to get into today. A lot of times people in a lot of times people are way too reactive when it comes to their tax planning or their tax returns in general. A lot of people think that going to a CPA and say March or April of the following year is being proactive, is having tax planning, and it's not. Good tax planning is throughout the year. So 2024, if you want to save money in 2024, it's about the things that you do over these next couple of months that are actually going to help you save money on taxes. If you wait until 2025 to start just even thinking about saving money in taxes, you're not going to save money in taxes, okay? Because there's only a handful of things realistically that somebody can do after the year is already over to save money on taxes. There's a couple of things you can go back and sure, you can make sure that you capture all your deductions and opportunities, things like that. But the actual strategic tax planning, that happens throughout the year. And that's something that you need to be doing throughout the year with an accountant, or you can obviously self-learn and study from some of my content or some other people's content. But tax planning is, what are we doing now to help you save money versus just filing your tax return? Because you could think of it almost like Monday morning quarterback, right? So I had the privilege of going to the Green Bay Packers, which is my favorite football team. They played the Colts. It was their home opener, and they actually won, which is surprising because they had their backup quarterback in the whole game because their starter got hurt. And I think of tax planning as if when you lose a football game, when I used to play football in high school and we would lose, it was always that Sunday or that Monday after where our coach would come in and tell us, all the things that we could have done or should have done to win the game. That's what the head coach would come in and say. But the right thing to do is to have a better offensive coordinator, have a better defensive coordinator that's actually going to call plays while you're in the game that are going to allow you to win the game. So instead of this reactive approach, it's being proactive and planning for your tax liability. So we help real estate investors all over the country. At one of my companies, either my tax strategy company or just my tax preparation company, I help you save money on taxes. And there'll be opportunities for you guys to learn more info about that later on in the call today. But I wanted to talk a little bit about, and if I don't see your comment, it's because the StreamYard's doing this weird thing with the Facebook groups now, so I have to toggle back and forth in order to see your comments. If you guys switch over to YouTube and go on my YouTube channel and comment on my YouTube channel, I should be able to see the comments coming out of there. So just FYI for you guys. Now, one of the things that I wanted to talk about are some examples of those missed deductions or opportunities. And you would be surprised at how many people don't take all the deductions that they're able to as a real estate investor, as a business owner, as a co-host, as a property manager, etc. So let me explain. So right off the top of my head, or right off the bat, it's just costs that are incurred when you have a rental property, right? So closing costs, for example, when you buy a rental property, we're reviewing about 20 returns a month now that are prepared by other CPA firms that are new clients of ours, but they did their taxes with an old CPA or an accountant. And we're reviewing these returns, and there's so many missed deductions on some of these returns. And I'm talking about things that are super basic, like property insurance. If you have a property, especially one that's on the beach, you're going to have some kind of insurance, and you're probably going to have extra insurance, right? Mortgage interest, property taxes, cleaning fees. These are types of expenses, like, believe it or not, a lot of investors are not taking them. And it's not that you're taking them, you're spending cash money on these expenses. It's just you may not know how to oversee or look over your accountant's work to make sure that they're actually taking advantage of all the deductions and expenses that you have. So it's things like that that are so simple that we see that people are missing, because you're going to an accountant that isn't real estate specific, and they're not looking for those deductions because they don't own properties themselves. They're not going to know that those are deductions for your rental properties. That's why on our team, most of our CPAs or most of our accountants are also real estate investors too. So we have an eye for being able to miss deductions and opportunities that we have an eye to see those missed deductions and opportunities that another accountant would miss. Other examples of missed deductions and opportunities could be a lot of short-term rentals. You're going to have 20, 30, $40,000 of like furniture and fixtures and renovations going into a property. So that way, when you do go live, a lot of that stuff should be expensed or depreciated, or that should show up on your tax return as a cost. And a lot of people, and I hate to say it, but a lot of times it's due to poor bookkeeping. It's because a lot of investors think that they don't need to hire a bookkeeper, that they'll just throw together a profit and loss at the end of the year and they'll be fine. But that is how you have 60, $70,000 of rehab costs, but only get credit for 40 or 45. It's because you're not keeping track of your books. And so you don't truly know how much money you spent out of that bank account, or you don't know how much money went into those properties because you're not keeping good track of it. So good, proper way to make sure that you're not missing any deductions and opportunities is to have really good bookkeeping. You don't have to hire a bookkeeper, but have some kind of system. Even if you had a VA, even if you had a virtual assistant that was the first level sort of block and tackle for you, do that first level transactions, and then and you're going to review your books. Let's just say once a month or once a quarter, you're reviewing your books. That's great. And then you have your accountant reviewing it. So by hiring a VA, you have 3 levels of review on your books. And so it's way less likely that somebody's going to miss an expense. And imagine if you added in a tax planner in there too, right? So you got a VA who's doing the books, you're overseeing the books, you're giving your books to a tax planner who's helping you do tax strategies. And then you're giving your books to the person who's preparing your tax return, which could be or isn't the same person that's going to be doing your planning, right? So you have 4 eyes on your books now. No chance you miss expenses or deductions, okay? No chance. So those are some of the missed deductions and missed opportunities. Another little sneaky one that I wanted to talk about, and this actually just kind of came up, and I bet pretty good money that this person is on the call that I'm talking about right now. But the person who is a real estate professional by trade, which means they work most of their time every single month in real estate, right? Month or the year, they're a real estate professional, so they're either an agent, they could be a property manager, construction, but they're what's called a real estate professional, right? And a lot of people think that real estate professional status only matters when you buy real estate. Well, it also matters when you sell real estate too. You see, there's this gain that's called net investment income tax. And I don't want to bore everybody to death, so hopefully you guys don't log off after I say this. But there is this tax called net investment income tax, where if you sell a property for a gain and you make over something, I want to say it's 250 if you're married, maybe like 170, 180 if you're single. But if you make over that certain amount of money from your W-2, from your real estate, whatever it is, you have an additional tax. You have an additional tax on your gain. So in addition to paying the capital gains tax, right, 15 or 20%, you also have this net investment income tax, which is like a surcharge to your gain. So it's 3.8% off the top. And this person had something like a $350,000 gain. I want to say $350,000 gain. So when you multiply $350,000 times 3.8%, you come up with over $10,000 in additional taxes that they had to pay in this net investment income tax. Well, guess what? If you're a real estate professional and you materially participate in that property the year you sold it, it's not actually subject to that net investment income tax. And 99% of accountants out there in the world do not know this exception. They do not know this rule. And it costed this person over $10,000. Luckily, she joined our real estate tax prep service, our real estate tax prep community. We reviewed her tax return, found this error, and now she's going to be able to amend it and get 5 figures back in taxes that she had to pay. And what sucks about that is that should have been $10K that she had in her pocket all along. Now she's got to go file another return with the IRS to get it. But it's things like that where if you guys are using the same accountant before you got into real estate, or maybe you have a business accountant and then you're starting to buy properties, they are not going to know the deductions and the strategies that you need to implement in order to save money on taxes. And they're definitely not going to know that nitty gritty that I just explained to you. So I highly would recommend. And it's almost kind of like they used to tell us in corporate America, if you didn't job hop every 2 to 3 years, you were probably leaving money on the table in form of salary, which was kind of true, right? If you don't job hop every couple of years, you're probably being underpaid. I think it's the same thing with professional services. If you had a lawyer, you had an accountant, or you had somebody that you were working with for a couple of years, it could very well be that that person kind of has some blind spots. Like there might be some strategies or some items that they may not be thinking about, and it might be great to have a second opinion on what you're doing to see if they can help you save more money, right? So I almost think of it like job hopping. Sometimes it's not a bad idea to move over to another CPA too. Mindy, thanks for mentioning. I see you in the chat. I'm going to go through this. Yeah, if you guys have questions, just post them. I'm going to get to the questions a little bit after I kind of go through my spiel and what I wanted to talk about today. So that's the gist of tax preparation versus tax planning, right? And now another sort of added benefit of working with a strategist is examples of just going above and beyond. Okay, if you've been following me for a while, you've been following the content, you've been listening to the podcast, you probably heard about a lot. You probably heard about 90% of the strategies that are out there to you as a real estate investor. But what you may not know about are some of those hidden gems, those little. It really takes you getting on the phone with somebody for us to uncover something like this. But the slightest thing can make the biggest difference. I'll give you an example, okay? And if I lose you guys, let me know in the chat, and I'll try to explain it as easy as I can. So we had a client last year who they owned a long-term rental property that had huge appreciation. I think it was in Arizona. And so they were selling a long-term rental for, I want to say it was about $400,000 of gains. Okay. And their plan to offset that was to buy another rental property. So they were going to take their $400,000 of gains plus the paid off equity in the house, take it, go buy more real estate, short-term rentals specifically, use what I call the poor man's 1031 exchange to use the losses from the new property to offset the gain on sale of the old property. It's a great strategy, by the way. But what they were missing out on, and what it took them signing up for our tax strategy services and me getting on a call with them to know this, is that poor man's 1031 exchange, the maximum tax benefit that you're getting on that is whatever the capital gain is on the sale of the property, right? So if I sell a $400,000 gain and I'm in a 20% tax bracket, it's $80,000 that I owe on that capital gain. And the taxpayer in this scenario, the depreciation that they had on the new property was like $200,000 of depreciation. So that 200,000 of depreciation goes towards offsetting the $400,000 in capital gains tax on the old property. And now they only have to pay $200K of $200,000 in capital gains tax, or $200,000 capital gains. So they pay $40,000 in capital gains tax, right? What they didn't know that I explained to them is they should really be trying to take the short-term rental loss against their active income, because they were in a 37% tax rate based on the taxpayers and the spouse's W-2s, right? So if you apply that, if you take that depreciation from that short-term rental and offset the capital gain from the sale of the long-term rental in the same year, you're only saving a max of 20%. But because they implemented this strategy, and I was able to walk them through this strategy and exactly how it works, they were saving 37% in taxes instead of 20. So that 17% difference on a $200,000 gain. This couple of clients of mine saved over $30,000 in taxes just because I was able to tell them that they should implement this exact strategy. Hey, you should wait to sell the property into the different year than when you buy the short-term rental. And something as simple as that, and this is nothing new if you guys have been following me for a while or what I teach, this is nothing new that I teach. I've taught this for years now, but it's having the critical thinking skills to know that this is the right strategy in this moment, and it saved my clients an extra $30,000. Okay. And so again, not a pitch, not a hard pitch at all for our services, but if you guys are high level real estate investors, if you guys have multiple properties, a couple of businesses, things going on, you really want to work with a tax strategist, because they're easily going to save you more than their costs, right? And I'm trying to think if I have any other examples. I was just on the phone with a client yesterday, and so just to give you some context, they're a little late to filing their 2023s. They couldn't find a CPA that knew what they were doing for 2023, so the client wanted to switch over to our firm for 2023, finish up the 2023 filing, and then do some tax planning from now until the end of the year for 2024. Okay, great. So their plan was they already ordered a cost segregation study on the property for that was placed into service in 2023, and their plan was to just file their 2023 tax return and get a big refund. Okay, not a bad way to go, not a bad strategy at all. 90% of people in this world will do that because 90% of people in this world are also lazy and they don't believe in themselves. But the top 10%, what they know is there's other options. And for this client, the other option was, hey, instead of taking the depreciation against your income in 2023 and getting a $30,000 refund check in 2023, what you should do instead is you have this IRA over here that has 100 grand in it and you want access to that cash, don't you? Yes. Okay. Well, the 100,000 of depreciation, instead of getting a cash refund of $30,000, what you should do instead is take that 100,000 of depreciation and apply it to the IRA withdrawal, because at the end of the day, you're going to pay that 30% in taxes on the IRA withdrawal, but now you're left with $70,000 instead of only $30,000 to go towards your next property. So it's things like this that a lot of people they might understand some of the strategies that I teach, or they might understand some of the stuff that's online, but to actually have somebody sit down and dive into your scenario and tell you what's the best recommended course of action for you to do. It's little things like that that can save somebody $30,000 in taxes or put an additional $70,000 in somebody's pocket for purposes of buying their next property, right? So I don't want to. It's just not really a super hard spiel, but just kind of something that's come up over the last couple of days since I did this live last week. So wanted to make sure you guys are aware of that. If you guys are interested, and again, this is not a hard pitch at all, but if you guys are interested in getting your tax returns prepared by a competent real estate accountant, as well as getting access to a community where you can ask questions, you need to go to, it's just retaxprep.com/Bill. Now, retaxprep.com/Bill, if you heard about me through Bill. If you know me and you're already on my email list and you don't know who this Bill guy is, well, then you go to this other one. You go to, and I'll wait till you guys see the whole thing. Then you go to retaxprep.com/apply. Okay. So one or the other based on how you heard about me. And that's the only sort of pitching that I'll do for you guys right now. And then we'll get back into the rest of the content. I don't think I could show both of these at the same time. Yeah. So it's retaxprep.com/Bill. You fill out a quick form, schedule a call with us and see how we can help you save money on taxes, or retaxprep.com/apply. Okay, one of those two. Now, I want to get to, yeah, so just to cap that off, that's really the difference between tax preparation, which is great. You need a good tax preparer, right? But you need somebody to go above and beyond. Somebody that, let me see if I can remove that. Sorry about that. You need somebody that's going to go above and beyond, right? That's going to ask the questions that need to be asked. For example, this cracks me up every time, because every single year I see this all the time. You got a property in the Smoky Mountains. In the mountains, I know in the Smokies that you have bugs and bears all the time. So you probably have pest control fees. But we look at so many returns prepared by, or we look at so many profit and losses from our clients that don't include pest control fees. And then we mention it to them like, hey, I know you have bugs and bears in there. Where are your pest control fees? And they're like, oh yeah, we paid $600-700 for that. Oh, here's the receipt for that. They didn't have that in their profit and loss. So it's things like that that takes a real estate CPA or a real estate accountant to know that your average accountant's not going to know, because your average accountant doesn't own real estate property or doesn't own short-term rentals. Okay. Let's get into some questions. So what I'm just going to do is whichever ones kind of come up to me first is what I'm going to answer. Now, here's the trick. If you're on YouTube and you comment on YouTube, it shows your nice face up here with your name. So thank you, Carolise. It shows your nice face up here. And then also shows your question. If you are commenting from Facebook, I have to go over to Facebook to see your question. And I can't show it to the entire screen. So it kind of sucks. But if you're on YouTube, Yeah, it looks like if you're on YouTube, you can actually put your comment on there or your question, and then I could show it up here on the board. So, is there a bookkeeping software you recommend? I still think QuickBooks is the tried and true above all in terms of like bookkeeping software. If you're a serious investor, if you have multiple businesses, if you have multiple properties, I think QuickBooks is a great option. If you are a smaller investor or not as sophisticated and you only have one or two properties, something like a Stessa is great too. Stessa, it's just stessa.com. They should give me an affiliate code, but I don't have one from them. But Stessa is a great option. I believe it's free, but you know what happens if it's free, then the product is you, right? They're probably selling your data or your information to somebody else. So Stessa is a great option if you want free, or I still believe that QuickBooks is kind of the industry standard, if you will. Now, a trick if you want to do bookkeeping yourself, and I explain this to a lot of people. A lot of people want to have a bookkeeper or somebody to do it, but they don't want to pay bookkeeper fees, which is great. Here's an idea though. When Henry Ford built the assembly line, or when he created the assembly line to build all the Ford trucks, he had this principle that he called the 10-80-10 rule. And basically what that meant is as long as he can control the first 10% of the inputs and he can control the 10% of the outputs, the other 80% of the task could be done by somebody else, or it can be outsourced. It could be done by somebody else, right? And so that's the way that I think about bookkeeping, or a lot of these like other tasks that we all have in our short-term rental business is like, what can I teach somebody, whether it's through a Google Doc or Loom videos or training videos, teach them to do something, have them do 80% of the work. And then I just need to set up the parameters both on the front end and on the back end to make sure that it's a good product. So that could be something like, okay, first 10% is making sure that your bookkeeper has the right tools to log into, making sure that they have all the right training videos. That's your first 10%. And then the 80% is them actually doing the work. And then the last 10% is you just overlooking the books once a month or reviewing their work to make sure that that actually shows up. So that sort of same framework is great for outsourcing any kind of remedial tasks that you might have to do in your business. So JR Ranks says using bonus depreciation was able to reduce income tax quite a bit in 2023, but was hit with a 70K self-employment. It shouldn't be that high. Self-employment tax, the most you can pay. Well, maybe I take that back. Social Security, I think the most you can pay in a Social Security is something like maybe 17, 18,000 bucks, maybe closer to 20, but there is no limit on the Medicare. Okay. So self-employment tax, just by the way, is Social Security, which caps out at whatever the wage max is. And then it's Medicare tax that doesn't cap out. The trick to saving money, and let me back up just a little bit. So this happens a lot actually with like realtors, property managers, people who are full-time in real estate. You're a lot of times you're able to fully offset your federal income tax, but you're not able to offset self-employment tax. And that's because it's a different tax. That's a tax on your wages, not on your income. But the best way to offset or reduce some of your self-employment tax is to have what's called an S corporation. So not an S corp, but an S corp. S corp. S corporation. If you're a real estate professional, if you're a real estate agent, fix and flipper, wholesaler, property manager, that the S corporation can easily save you 5 figures a year in taxes, most dominantly on the self-employment side. And I have videos on that too. If you go to my podcast, Learn Like a CPA show with Ryan Bakke, you'll see some of my podcasts that I've done on that, on S corporations and how they can save you money. But remember, you don't want to hold your rentals in those S corporations. So you only want to do ordinary business activities inside of your S corp. Carl says, I agree that QBO is the industry standard. And if something is free to you, you're the product. Yep, exactly. Exactly. Thank you. I've lived in primary residence for a few months now. I am running it as Airbnb while I travel overseas. I have W-2 income. Can I take advantage of costs like this year? Yes and no, maybe, because you're going to have to figure out the whole personal versus rental use. Anytime you have a property that's mixed use where it's like you're living in it some parts of the year and you're not, you have to prorate the days, or you have to bifurcate the days between rental and personal use. And if you run amok of the personal use rules, which again, go check the podcast out. I have one of the podcast episodes talks about the personal use versus rental use. Basically, if you're living in the property more than 14 days, you're going to get tagged personal use. And so you're not going to be able to deduct a lot of expenses that you have that other real estate investors who solely rent the property out for rental purposes and don't live in it or use it for personal use are going to be able to take advantage of. So, I mean, first I would figure out to the extent that you are using it on personal versus rental, and then decide what sort of tax strategy you're going to want to implement. Okay. So I'm going to switch over. So these were comments on YouTube. So thanks. I'm going to switch over to Facebook, see what's up in Facebook. Always great advice from Ryan. Thanks, Ryan. Hi, Ryan. Good to see you. I'm not seeing any questions coming on Facebook. If you got a question, try to pop over on YouTube. Try to pop over on YouTube and see if you can ask it too. And if I don't get to your question on the live today, I'll respond to it after sometime later today. Here's a question. So to use the short-term rental loophole with taxes, would pad split be considered an STR? I'm not super familiar with pad split, but I would say, is the pad split where you don't actually own the land, but you own the whatever's on top of it? Because in that case, it's very similar to like condos or condos or like HOAs, right? So let me stop sharing this comment. Yeah, so somebody on Facebook asked, to use the short-term rental loophole with taxes, would pad split be considered STR? I think so. I think it'd be very similar to how you rent out a condo or a townhome. So a lot of times what I teach people too is where you buy real estate is super important for tax purposes. So for example, if you buy property, you want to buy property in areas that have very low land allocation. So Midwest, Smoky Mountains, anywhere where the land is not worth a lot is great for tax purposes because you get more depreciation and you get more tax benefits. You really want to try to stay away from areas like a Destin, a 30A, New York City, Florida, California, Seattle, like anywhere where the land is worth an ungodly amount of money. You kind of want to stay away from it. Just because you're not going to get as much in tax savings. Now, one of the things that I teach people is that if you are a high earner and you need as much tax savings as you can, one of the good strategies is to actually buy a property that's in a condo or an HOA, because you don't actually own the land that the property sits on. Or sometimes you might own the land, but it's a very small sliver of land. It's like 3 to 5% at most. And so the best explained by an example, right? So we had a client in 2022 who bought $1 million property in Smoky Mountains, Tennessee. And because she's in a 37% tax bracket and she implemented some of the strategies that we teach, she saved a bunch of money in taxes, over 6 figures in taxes saved. So then she bought another property in Gulf Shores, Alabama. And if you know anything about Gulf Shores, you know that the land is worth so much money in Gulf Shores. And she saved like a third of the amount of taxes that she saved because of the Smoky Mountain purchase. And it was because the land in Gulf Shores was a ridiculous amount. The land was worth like 60% of the purchase price. So you're not going to get as much tax benefits because of the area and the location that you invest in. So I teach investors, I teach our clients, you hear me talk about it on the podcast all the time, where you invest is extremely important if you're looking to save a lot of money on taxes. You never buy real estate just for the tax benefits. Never, ever, ever do that. But if you are a high income earner and you are looking for those tax benefits, where you buy property is extremely important, okay? And to talk a little bit more about that, there's 2 reasons why you want to go through this exercise. And what this exercise is you want to, before you buy the property, so this could be like when you're under contract, this could be before you go under contract, but before you buy the property, what you want to do is you want to go on the county tax records of whatever that county you're buying the property in, okay? So if I'm under contract on a property, I'm going to go on the county tax assessor website, look up that property's tax info. Here's what it's going to tell you. It's going to tell you the breakout between building, and it's going to tell you the breakout between building and land, okay? And what that percentage or what that ratio represents is basically how much money you're going to save in taxes, right? Because we're looking for properties that do not have a lot of land value. that do not have a lot of land value. We don't want any land value. Okay. We want as much of it to be building as possible. Okay. And so what you can do if you're unsure is go look on the county tax website for the property building versus land breakout. Here's another thing you could do if you're unfamiliar. Go find recent comps in that area. So if you're buying a 5-bed, 3-bath in Miami, 2,400 square feet, 2,600 square feet, go look at other properties that have recently sold that are similar to that. See how their property tax bill is, see how their building to land ratio is, and that'll give you a better idea of how yours are going to be. Okay. Here's the other reason why you want to do this. Okay. So number one, tax benefits. Number two, you really want to be certain about property tax reassessments, especially in a state like Florida. Okay. Because in most states, and this is not every state, so I don't want to say every state, but in most states, a sale of a property is going to trigger a property tax reassessment. So the county is going to go in, give you a new building value, a new land value, and they're going to trigger an increase in property taxes. And a lot of people, especially people who do new construction, a lot of people are thrown off by this, and they're almost like taken by shock because they didn't think that the tax bill would be that much. And I'm not trying to pick on realtors, I'm not picking on brokers, but 9 times out of 10, when you get the pro forma or the investor sheet from a realtor or a listing agent, it's got the current owner's property tax bill on there 100% of the time. It doesn't have the fact that, oh, that 8K property tax bill is going to be 11K after you buy it. It's not going to have that in there. It's going to have the current owner's property tax bill. So as an investor, these are the reasons why you want to do an exercise like this. Number one, to figure out how much money you're going to save on tax benefits. Number two, you want to know how high that property tax bill is going to get reassessed after you purchase. Okay, so those are the two reasons why you're going to do this exercise, and it's a great exercise. I mean, we do it before we buy any property. I mean, really, before I even put a property under contract, I'm doing this exercise because I need to know these types of things. I need to know what my property taxes are going to be. I need to know what my insurance is going to go up to. I need to know all these things. I can't find out about these 3-4 months into buying the property because then the math ain't going to work. I can only drive up revenue so much because I only have 365 days to rent my property out. Okay. What is a low land value? 10, 20%? I would say anything lower than 20 is like a low. I mean, just to give you some comparisons, like over here in the Midwest where I'm at, Chicago area, a lot of times it's 15 to 20% standard, 15%. You get in the Smoky Mountains, I mean, I've seen it as low as 3% in the Smokies. Big old 6-bed cabin, I've seen 3-4% land value. It just kind of depends on where you're at, and that's why I said it's important to find if you're looking for tax benefits, find an area that does have a low land value because it'll mean all the difference in the world. Oh, this is a good question. Okay. Yeah. So DP Videos asks, I've lived in primary for 2.5 years due to recent relocation. Basically, decision to either sell it at a big loss or turn it into rental and use the tax losses later for W-2 and rental. Okay. This is a great question. This is something that I guide people through on my tax strategy investor calls that we do. But just to give you the idea in theory, a lot of times when I explain this, it's because people have a big gain on their property, a big increase. The fact that you have a loss, here's what happens. Okay, this is a very nuanced rule. So I want to explain this rule for you just so I can answer your question, but then I want to go a little bit broader because I feel like your case and your scenario is like 1 out of 100. Most of the time when we work with people who are selling their primaries recently, they're selling them at like gains. Okay. So the IRS, let me give you a story. Best explained by a story, right? So in 2008, when the real estate prices crashed, what a lot of people were doing is, hey, if I sell my primary home for a loss, it's a capital loss. I don't get to deduct anything against my active income, right? So people thought they could get smart, and they thought that they could convert their primary into a rental and then sell it at a loss, and then it all becomes a regular business loss. Well, the IRS has already put in rules and safeguards around that. And so what happens is you'll still have losses on your tax return, but the thing is your basis in that property for depreciation purposes is not the price that you bought the property for. it's actually if the value that the property is when you turn it into a rental is lower, then that becomes your basis for depreciation. So whatever your fair market value of the property is now, that's your basis for depreciation, assuming that it's lower than your original purchase price. But this, like I said, this scenario is like 1 out of 100. You know, whether or not you sell it at a big loss or turn it into a rental, um, you got to kind of outweigh the pros and cons. Like, are you selling it at a capital loss? Like, let's say you take a $50,000 dip, or you can turn it into a rental and you're cash flowing $500 a month or whatever. So then you need to rent it out for 7 or 8 years, so that way you don't have to take a $50,000 loss. It's a little bit more of an advanced question, but what I would do, are you upside down in it? Do you have negative equity in it? Because that's another factor to consider too. Because assuming you have actual equity in the property and you're not gonna have to give money to the bank when you sell, you're comparing the equity that you have in the property compared to what you can make it as a rental. Okay. And as long as that amount is comfortable to you, then you just convert it into a rental and you rent it out. But if you have a lot of equity in the property and it's going to take you 20, 30 years of renting it out to make back the equity that you have in it, then you sell it and then put the money into something else. Um, does you Christy Norman, again, sorry guys. So if you're on Facebook, it does this weird thing where it doesn't show your comments. You gotta put them on YouTube. Um, but here's a question. So, does your business need to generate a minimum amount of income for your business for the S corp to be beneficial? Okay. So when I first started teaching about S corporations, this was probably back in 2020, 2021, and at the time, it was right around the $65 to $70,000 net business income. So net take home pay to you as an owner before you pay yourself. So I have $100,000 revenue, I have $30,000 of expenses, so my net income's 70K, right? Anything more than that, that used to be my opinion. That used to be my opinion. 3 years ago. Now, I really think because of inflation and just the rising cost of everything, that amount needs to be probably closer to 95 to 100K. So I would say 90 to 100K is the minimum amount of net income, not gross income, by the way, net income that your business needs to be in order for it to be an S corporation. I would just say that off the bat. Now, there's a lot of other things that are at factor here. So number one is like, are you in New York, California, or are you in New York City, California, Tennessee, Texas? Because there's some states that are less favorable for S corporations than others, right? So there's some states where you may not want to set up an S corporation, even if you're over that $100,000 threshold, right? Now, the other thing I would say is like, how long are you going to be in business for? Because if you're only going to be in business for like 1 or 2 years, I don't think it's worth the cost of setting up the S corporation to save money, because you're not going to be in business in perpetuity. So as long as you're not one of these states and you're in business in perpetuity and you're making over 100K, I think the S corp is good to look into for you. But when you do pay yourself on an S corporation, it is through W-2 payroll. So you do have to run a payroll for yourself, cut yourself a W-2 salary, and that's how you're going to pay yourself. So it's not a 1099. You cut yourself a W-2 salary. Let's see what else. Yeah, good questions there. Sorry, I'm just taking a sec to try to find any other questions. If you guys have questions, post them in Facebook or post them on YouTube. YouTube would be preferred because then I could show your nice face along with your question. Okay, cool. We've been going for about 45 minutes here. Sorry, one more question. Yeah, so if you're considering an S corporation, but you don't meet the income requirements just yet, I would want to make sure that you're still taking advantage of all the other deductions and strategies that you can, even if you don't have an S corp. So, for example, like self-employed retirement accounts, health insurance through your business, potentially paying your kids if they're of age to work in your business. What are some of the other strategies outside of just being an entity or being an S corp that you can do to save money on taxes? And then once you do become an S corporation because you meet that income threshold, you then you file to be an S corporation. Then you start saving more money on taxes. Susie asks, "Can I do a cost seg for 2021 retroactively?" So you can, as long as you did not elect out of bonus depreciation in 2021. So there was a lot of bad, I would say, education for accountants on short-term rentals, real estate in general, that for whatever reason they were all told that they should just automatically elect out of bonus depreciation each year. And if that happened on your return, then you are not able to go back and change that. You basically can't go back and change that once you've already made that election. But assuming that you didn't make the opt out of bonus depreciation, you can do a cost seg retroactively to 2021. The sort of like thing we have to look at is um, the thing that you have to look at is it worth it? Because you've already been depreciating the property for 3 or 4 years now, and you got to see how much tax savings there are on the property to be had by doing the cost seg study. Because sometimes the further the years go on, there's not as much meat on the bone to save by doing a cost seg study. You would have wanted to have done it in 2021, but fortunately, you or me don't have a time machine. So, um, I have an S corp, but don't meet the income. I've been an S corp for years. Yeah, I mean, like I said, there's you'll save. You're going to save money in taxes regardless. If you make 50K net income, 60K net income, 100K net income, it's just, is the juice worth the squeeze? Because when you have an S corporation, like you said earlier, you got to have separate books and records. You got to put yourself on W-2 payroll. You got to file an extra tax return. Now you have to. Now you have to worry about unemployment insurance and unemployment taxes and things like that. All these other things that you wouldn't have had to do if you're just filing as a sole proprietor on a Schedule C. Yeah, Carl made a good comment. Work with the tax pro to consider the cost benefit of continuing it versus winding it down. Yeah, we see a ton of people all the time that just have like just random entities and things floating around there that they're still paying fees on for. All right, I think. So a question over here on Facebook, and this will be the last question that I get to. So Pearl asked, "Are there any risks to being eligible for the STR tax loophole if I buy the property under my name and then transfer it to an LLC after closing?" Let me hide the comment. So the question was, and this will be the last question, guys, of the day. So the question was, are there any risks to being eligible for the STR tax loophole if I buy the property under my name and then transfer it to an LLC after closing? Okay, so some things I want to talk about first is that you will always get it's always quickest, easiest, cheapest to close on a property in your personal name. It's kind of like that. You remember those what were the Billy Mays commercials where he's like, it's the quickest, cheapest, cleanest way to clean something or whatever. It's always going to be quickest, cheapest, easiest to buy a property in your personal name. You're going to get the best rates, best terms, best loan products, right? Because you get to use a personal loan, conventional Fannie Freddie, instead of having to go through an investment loan potentially. The tax man or woman, they don't care how you own the property, whether you own it in your personal name or you own it in an LLC. Okay. Now they will care obviously if you own it in an LLC with somebody else, right? But if it's just you personally or a single member LLC that you own 100% of, the IRS necessarily care about that. What they really care about is, are you on the hook for the debt or not? Okay. So are you on the hook for the debt or not? That's what they care about, right? Now, we just recently got through an audit for the short-term rental loophole, and the client had properties in his personal name, and as well as he had he had properties in an LLC. They barely asked any questions about that. Realistically, they just wanted to see that the entities were titled into the right name, whether they showed up on his LLC return or on his personal return, and that was about it. So it's always going to be, this is what I tell people, like paralysis analysis, right? And I don't know if you guys were a part of my 3-day challenge, but that's one of the lesson that I talked about on day 2 was, hey, look, you don't let this whole entity structure thing be a roadblock to you to starting your portfolio or like building your portfolio. Okay. You do want to make sure that you get it done right the first time. And it's not like starting a race with your shoes tied together in knots, right? But don't let it keep you up at night. Don't let it stop you from investing. But you definitely do want to make sure you get it right. Don't go buy a property and somebody else is on the loan, but they don't own the property, right? Don't do any of that. Either buy the home in your personal name, you're 100% owner. Buy the property in an LLC, you're 100% owner. But that's something you do want to get right from the start is your entity structure. But definitely don't let it keep you up at night. And so, yeah, that the 3-day challenge that I just ran, you might be able to go back in my Facebook group and see some of that material. But that's a great starting point. If you guys have questions about your entity structuring or how you should be set up for tax purposes, I could do a whole nother live event on that. Maybe we'll do it next week if enough people want that. Maybe we do it next week, but yeah, definitely don't get caught up in all that, right? I think one last thing, and again, if you guys are looking for help in the tax department, right? If you want a real estate accountant, if you want access to a community where you guys can ask questions, trainings, materials, and get answers to those questions, this is the link right here in the chat. Just retaxprep.com/apply. Fill out some information, book a call with somebody on our team, and we'll chat with you about how we can help you this year save money on taxes and prepare your tax returns. Okay. So that's just retaxprep.com/apply. Let me see if I can also put it in the chat there. Purchasing a property in your trust, same thing. Like I said, the IRS doesn't care how you really own the property. What it does matter is from an entity protection perspective. Now, I'm not an attorney. I'm certainly not your attorney, right? That's something you have to work out based on your own financial net worth. Sub $2 million net worth, I don't see people using a lot of trust, to be honest with you. Not that they shouldn't have it. I think you hit $1.5 million, $2 million net worth. You got a couple of kids. You should have a trust at the top of your holding structure, right? And that's going to own a disregarded entity that's in an anonymous state, and then that's going to own your rental properties, right? But again, this is all kind of stuff that it's like, let's focus on what matters first, and that's getting your first property or getting your next couple of properties, and then let's worry about setting up your entity structure. Not like we have untangled a lot of bad entity structures before, but I don't want to let that get in the way of you succeeding with your investing journey. Okay. I want to be very clear about that. So yeah, retaxprep.com/apply. If you're interested in becoming a tax prep client and getting access to our community, that's a little bit different than my tax strategy people, though. My tax strategy people, you know who you are. You have a lot more access to me. We do weekly calls in that group, and so you know who you are. And then the last thing, guys, just quick announcement. A lot of people have been asking for it, but the next 2-day boot camp, tax strategy boot camp, is going to be on October 3rd and October 4th. I haven't sent out any emails about it. I haven't announced it yet, but you guys kind of have the ear to what's going on. And that's going to be 2 days jam-packed of just tax knowledge, investing knowledge, asset protection knowledge, self-directed IRAs, bookkeeping, legal, all these types of things. Scott's been there before. I think Scott's been to the boot camp before, but just like literally just 2 days of everything you need to know to be a successful real estate investor. And I'm going to deliver that to you guys via Zoom, 2 days from 10 to 5 each day. That'll be Friday, October 4th. And is it October 4th and 5th? Yeah. Yeah. Friday, October 4th and Saturday, October 5th. My next tax strategy boot camp. So be on the lookout, be on my email list or be in the Facebook group to get tickets and get a seat with that. You'll be able to dive in, learn from me, learn from all my CPAs, be able to interact with each other, and it's going to be the best one that we've ever done. So thank you everyone again for the time today. Thanks for spending almost an hour with me. If you guys have more questions, try to post them in the Facebook groups, and I'll try to get to them later on today. But other than that, I'll see you guys next week on Tax Tuesday, and hopefully Bill's back. Thanks everyone. Talk to you soon, and have a nice day. Bye.